Hello, this is Steve Malone with Compass FX. I hope you're doing well today and you're getting some good trades. In my video series about trading with the pivots, I want to share with you another type of trade that follows the pivots. It's called the pullback trade. Some actually have the nickname the slingshot trade. And what we're looking for is when the market reaches a certain pivot level. Once it moves from that pivot level to another pivot level, then retraces back to the original, it's been pulled back, then as it resumes its direction in the original direction it was going and breaks a high or a low, we look to enter the market at that level. Now that may have sounded a little confusing, but just let me show you what I'm talking about here. The market had reached up to the pivot today with the Aussie yen. Then it pushed up to the R1. This was the pivot today. This is the R1. Then it pulled back to the pivot like a slingshot being pulled back, and then it launched. And now what we could do with Synergy trading model is as it came off of here, we already have a target in mind up here, so we could have actually entered here. But based upon the pullback trade, or the slingshot trade as it's nicknamed, we could have actually entered somewhere right around 83.05, the average high, or the highest point around 83.08, and see the market move up. Now it didn't move up a whole lot. It moved up to about 83.20 and then fell back down a little bit. But check this out. The CAD yen had an incredible move today. It did exactly what I talked about. We bounced along here, worked our way above the pivot to the R1, pulled back to the pivot, and then like a slingshot, it came out from the pivot beyond the R1. If you had put an entry on the break of this high point right here, it made a move all the way to the R3 today. That's a 44 pip trade today on the CAD yen. That is a prime example of the pullback, or what some refer to as the slingshot trade. Now something to look for as we trade this is when this pulled back right here, what we're going to take a look at is the TDI. What did the TDI do? We have the direction of the market here with the market baseline. So as the market pulls back, or the TDI pulls back a little bit here, but stays above the previous low point, we get a return back to the upside. There is strength and momentum in that direction. You can see it back here on the Aussie yen. Same thing happened. When the market pulled back right here, the TDI came back, but notice that the market baseline, the yellow line, continues on an upward path. We didn't break there. We literally took a bounce and we took another push. And we made another high here. Higher lows, higher highs, continuation in that direction. But this was a beautiful pullback trade today using simply the pivot levels. So again, you want to see that the market breaks a level, goes to another level. Then as the market pulls back, you set your trade on the break of this high, or the average high here, and as it comes back through, your entry point is going to be on the break of this high point. Now if you're using the Synergy model, we know using Synergy that you can look for the market breaking above the price action channel and enter before that move to the upside right there. Now this happens when you're trading short as well. Let's take a look at the pound dollar. A few days back we had the pound dollar do a similar situation here, but it took a period of a couple of days. So in this case we were around the pivot. We made a decent little move all the way down to the S2. The market pulled back to the S1. So as you can see here, we pretty much maintained that level. One day it was the S1, the next day it was the pivot. We maintained that level. That's our pullback point. And then the market does like that slingshot. It pushes back towards the other pivot levels all the way down almost to the S3 the following day. This is a technique to look for. So in this situation here, when the market pulled back to this level, it carried over the following day, then a break of this low would be your entry point. And notice how the market hit that level, hit that low. That low point was the S1 for the next day, and then it bounced along, and then finally the market broke down and continued on going. Now take a look here. In this case right here, we were moving down. Market pulled back up. Notice how the volatility bands got pretty tight right here, that the market's tightening down right here. It attempted to move to the upside and then made a immediate move back down. This level here could not break the high back here. Not breaking this high, this acts as a outside structure in the market, and then what we're looking for is these inside bars inside this outside structure. Then we look for that. If it doesn't break above it, then we look for it to break below. Sure enough, it breaks below finally and makes a push all the way down to the next pivot level and then almost to the following pivot level. And we can see that happening also down here where the market pulled back a little bit, bounced off the market baseline, and then pushed down again. So this again is just a simple little technique of watching the pivots as you trade. Once the market maintains a certain pivot level, let it push one way or the other, up or down to the next pivot level, like going from, in this case, we went from the pivot to the R1, back to the pivot, then it pushed beyond the R1 and pushed all the way to the R2 and then the R3. Oftentimes you'll see this happen between the R2 and the R1. Sometimes what we'll see is that when the market makes a push to the R2, we fade back to see if the R1 will maintain support. If the market fades back to the R1 and maintains the R1 and then starts getting another bit of strength in the direction of the original trend, then look for that next push to potentially take you all the way to the R3. This is Dean Malone with Compass FX. Y'all make it a great day. Get some good trades. We'll talk to you next time. Bye-bye.